Welcome to The Explainer. You know, when we think about building massive wealth, our minds almost instantly jump to the thrilling stuff, right? The wild stock market rallies, soaring cryptocurrencies, or those massive complex business deals you read about in the news. But true generational wealth, it isn't just about taking wild risks. It's really about building a solid, unshakable foundation. So today, we are completely demystifying what we call the quiet wealth builder, bonds.
Okay, let's dive into this by asking a really crucial question. What do wealthy people actually do to stay rich? Because getting rich quick and staying wealthy are two very different things, especially when those hype investments can literally crash overnight. The truth is, while explosive growth assets might make you wealthy temporarily, it's often the boring, predictable investments that actually ensure you stay that way for life.
To unpack exactly how they do it, we've got a clear four-step blueprint today. First, we'll look at the quiet wealth builder. Second, we'll go inside the bond machine. Third, we'll cover the golden rule of pricing. And finally, building your fixed income strategy.
Let's jump right into part one, the quiet wealth builder and how you lay that foundation.
Think of your portfolio kind of like building a house. If risky stocks are the beautifully painted walls and the roof, bonds are the solid concrete foundation holding the whole thing up. When you buy stocks, you're becoming a part owner of a company, which brings variable returns and honestly pretty high volatility. But with bonds, you aren't an owner at all, you are a lender. And because you're a lender, you are legally entitled to regular, much more stable income to keep your financial structure sound.
So, what exactly is it? Simply put, a bond is an IOU. It's a legally binding agreement where you lend your money out today in exchange for regular interest payments and the absolute promise that you will get your original money back on a specific later date. It's kind of like lending money to a trusted friend so they can expand their business, except in this case, the borrower is a major, highly established institution.
And who exactly are these borrowers? Well, bonds are issued by national governments building highways, local authorities funding hospitals, and major corporations building new factories. And honestly, the absolute best part is that you don't have to be a multi-billion-dollar bank or some ultra-wealthy elite to get in on this. Everyday people, from market traders to students to salary earners, can lend their money and earn this exact same stable income.
All right, moving on to part two, let's look inside the bond machine and break down the mechanics of fixed income.
Looking under the hood, the absolute core of this entire machine is the face value. This is the exact original principal amount that the issuer is borrowing from you. So, let's say you purchase a bond with a face value of 100,000 naira. That is the exact amount you are guaranteed to get back when the loan ends, which is what we call the maturity date. This right here is the solid anchor of your investment.
Now you might be wondering, why on earth would you tie your money up for years? Well, because you're compensated with the coupon rate. This is your regular interest payment. And here's a fun historical fact for you. It's actually named after the physical paper coupons that investors used to literally snip off their bond certificates and hand to the bank for cash. Today, obviously, it's all digital, but it still provides you with that sweet, regular fixed income.
Let's actually see how this all comes together in a typical 5-year bond journey. Picture this. You buy a Nigerian government bond with a face value of 500,000 naira and a 12% coupon rate. Year 1, you earn 60,000 naira in interest. Year 2, another 60,000. This repeats every single year like clockwork. You're collecting regular cash predictably, and then finally, in year 5, you get your last 60,000 naira interest payment, plus your original 500,000 naira capital comes right back to your account.
Now for part three, the golden rule of pricing and how you weather the economic storm.
So, what happens if the economic weather totally changes before your bond matures, and you suddenly decide you need to sell it early? Well, here is the golden rule of bonds. It's a massive seesaw effect. Let's say you hold a bond paying 10% interest. Suddenly, the central bank raises new interest rates, and brand new bonds are paying 15%. Well, nobody wants your old 10% bond anymore. So, when new interest rates rise, the market price of your older, lower-paying bond has to fall in order to attract any buyers.
But conversely, what if new interest rates suddenly drop down to 7%? Now, your older bond that's paying a massive 12% looks extremely attractive to everyone in the market. Because everyone wants that higher yield, the market price of your bond shoots up. This means if you needed to sell it early, you could actually sell it for a handsome profit, making more than your initial face value.
Now, look, no investment in the world is entirely risk-free, right? We definitely have to manage bond risks.
Think of investing a bit like crossing a road. You can't totally eliminate the danger, but you can definitely look both ways. You've always got to watch out for credit or default risk. That's just the chance the borrower simply fails to pay you back. Then there's inflation risk. If inflation is hitting 18%, but your bond only pays 10%, rising costs are quietly eating away your real returns. And finally, liquidity risk. Basically, how easily can you sell your bond if you hit a sudden emergency and need cash immediately?
Which brings us to our final section, Part 4, Building Your Fixed Income Strategy. It's time to actually lay those bricks.
Now that we know the mechanics and the risks, it is time to build your personal strategy. Getting started really just requires 3 clear steps. Step 1. Define your specific financial goals. Are you saving for a house in 3 years? Are you eyeing retirement in 20? Step 2. Understand your personal risk tolerance. Are you going to panic if you see a temporary drop in value? And Step 3. Build what the pros call a bond ladder. This simply means spreading your money out across different bonds that mature at different times, like mixing 1-year, 3-year, and 5-year bonds. This gives you regular access to your cash and drastically reduces your risk.
Let's look at a real-world example, like a conservative investor portfolio. Think of someone like Ada, a market trader in Lagos who has worked incredibly hard to save up 2 million naira. She wants capital preservation above all else. A perfect setup for her would be 70% heavily weighted in safe bonds, 20% in stocks for a little bit of growth, and 10% in cash. This ensures her hard-earned money stays safe and keeps generating income even if the markets crash. On the flip side, we have an aggressive investor portfolio. Consider David, a first-generation crypto investor in Abuja who absolutely loves high-growth, high-risk assets. Even for David, allocating 30% of his portfolio to bonds provides a necessary, concrete shock absorber. When his riskier 60% stock or alternative assets take a massive hit, and they will, his bond foundation keeps his entire financial house from totally collapsing.
But what's the ultimate key to wealth here? The real secret sauce is the magic of compounding. This means taking that regular coupon interest we've been talking about, and instead of spending it, you immediately reinvest it to buy more bonds. You literally start earning returns on your previous returns. Over years and decades, this turns your money into a massive, self-growing wealth machine, and you don't even have to lift a finger. Time in the market matters so much more than the amount you start with.
To wrap up this explainer, I want to leave you with this final, incredibly powerful quote from our sources today. Wealth is not built only by taking risks, it is also built by managing risks. So I got to ask you, looking at your own portfolio today, are you just taking wild risks hoping to get rich quick, or are you actively managing those risks to secure an unshakable financial foundation so you can stay wealthy for the rest of your life?